go over a couple of journal entries. On September 1st, there are 2 transactions that are recorded into journal entries. The first transaction involves an owner, Ray Neal, investing $15,000 cash into the business. The 2 accounts involved are cash and owner's capital. They both increase. Cash, an asset, is the debit account because assets increase with debits. The owner's capital account, an owner's equity account, is the credit account because owner's equity increases with credits. Let's now look at the second transaction. The company Softbite purchases computer equipment for $7,000 cash. The 2 accounts involved are equipment and cash. If you are not sure which accounts are affected by the transaction, many times the accounts involved may be included in the description of the transaction. In this transaction, the asset account, equipment, increases, and therefore is the debit account because, consulting our chart, assets increase with debits. The second account involved, cash, is also an asset account, and because there is a decrease in cash, the cash account is the credit account. This slide reflects the journal entry for a purchase of a delivery truck with a cash down payment made on the truck with the remainder of the balance on account. This transaction actually involves 3 accounts. The asset account delivery equipment increases, so it is the first account that is listed because assets increase with debits. The asset account cash decreases because the company is making the down payment on the truck. Cash is credited because credits reduce assets. After the first 2 accounts have been entered, we see that the journal entry is not in balance because there are debits of $14,000 and credits of $8,000. The third account, accounts payable, a liability account, increases because the company now has a debt for the balance due on the truck purchase. Accounts payable is credited because liabilities increase with credits. Note that now debits of $14,000 equal credits of $8,000 plus $6,000. This is an example of a compound journal entry because it includes not 1, but 2 credit accounts. The previous slide included 2 simple journal entries that had only 1 debit account and 1 credit account. This slide shows how the transaction of an owner investment of $10,000 is entered. Follow these steps when recording journal entries. First, determine the 2 or more accounts involved, and if they have increased or decreased. For this transaction, cash and owner's capital are affected, and they both increase. Next, determine what type of account they are: asset, liability, owner's equity. In this example, cash is an asset, and owner's capital is an owner's equity account. Next, apply the debit-credit rules to determine which accounts are the debit accounts and which accounts are the credit accounts. Cash is the debit account because assets increase with debits. Owner's capital is the credit account because owner's equity accounts increase with credits. Next, enter the transaction as a journal entry. Note, the journal entry reflects the proper format of listing the debit account cash first and the credit account owner's capital indented and last. Finally, the journal entry information is transferred or posted to the specific accounts in a process called posting, which will be discussed in the next few PowerPoint slides. discuss the T account presentation. Here we look at a different presentation of the account form. The cash account, numbered 101 in this example, reflects 7 transactions during the month of June 2010 that affect cash. On June 1st, there was a journal entry that includes an entry of $25,000 into the debit column of cash. After this transaction, the balance of the cash account at June 1st is a debit balance of $25,000. The next journal entry that affected cash was on June 2nd, involving an entry into the credit column of cash for $8,000. From our new credit rules, we remember that credits decrease assets such as cash. Therefore, the balance on June 2nd after this transaction is entered is a $17,000 debit balance. This balance was arrived at by subtracting the credit of $8,000 from the debit balance of $25,000. When you look at the dates that contain debits to cash, you will see that the balance in the last column increases. The balance decreases after dates that contain credits to cash. Posting is the process of transferring amounts from the journal entry in the general journal to the accounts in the general ledger. Here, the journal entry reflecting an owner investment of $15,000 on September 1st is posted. The $15,000 debited to cash is posted to the cash account number 101 in the general ledger. The 101 entered into the reference column of the general journal signifies the amount has been transferred or posted to the cash account in the general ledger. In a similar manner, the $15,000 credit to Arneal Capital is posted to account number 306 Arneal Capital in the general ledger. After posting, the number 306 is entered into the reference column in the general journal. A trial balance is a report that contains all accounts with a balance as of the report date. This particular trial balance is dated October 31st, 2010. Take note of the order of the accounts. The accounts are listed as represented by the accounting equation assets equal liabilities plus owner's equity. The 4 asset accounts are listed first, starting with cash and continuing in order of liquidity. Do you remember the normal balance of assets? You guessed it. These 4 accounts have debit balances with the amounts listed in the debit column. Then the 3 liability accounts are listed. As expected, since liabilities have normal credit balances because they increase with credits, the 3 liability balances are listed in the credit column. Next, the owner's equity accounts, owner capital, and owner drawing are listed. After that come the revenue accounts, and finally the expense accounts. The debit and credit columns are totaled to ensure that they are the same. You will see in this trial balance that total debits of $28,700